Hello everyone, in this video today we're going to be going through the topic of purchase discounts, the gross versus the net method. Okay, so basically these are used when companies are recording the purchase price of inventory. Okay, and so companies use two different methods to record the purchase price of inventory, and these are the methods. So the first one is the gross method. Inventory is recorded at the full amount paid for the inventory without factoring in any purchase cash discounts that the company may take. Okay, so when a company buys inventory, a lot of times they'll have cash discounts offered to them on terms of maybe 210 net 30, something like that. And when we're using the gross method, we kind of just ignore those cash discounts and we just say we're going to record the inventory at its full cash price. So if the cash price of the inventory is $5,000, if that's what it costs us, we just record it at $5,000. Okay. Now the net method, inventory is recorded at the net amount the company expects to pay for the inventory after factoring in any purchase cash discount the company plans on taking. So in the net method, if we have the same inventory that costs $5,000, but we have a 2% discount that we expect to take, we actually will record the inventory not at $5,000, but at $5,000 less the 2% discount, which is saying the same thing as 5,000 times 0.98, which should be $4,900. Okay. So we record it at the price that we actually expect to pay, which is going to be $4,900 in this case, because we expect to take a 2% discount. Okay. So that's basically just a quick introduction to the two methods. Now, under the gross method, then we're going to just go through some more details, okay, on both methods. For the gross method, under the periodic inventory method, okay, so we have these different sort of inventory systems. One is periodic, one is perpetual. And so we're just going to go through for both methods basically what we need to do under both of these systems because it will change. Okay, so for a periodic inventory system with the gross method, if a company later takes the cash discount, it credits an account called purchase discounts and debits accounts payable. And the purchase discounts account is a deduction from purchases, which is shown in the income statement. Okay. So basically, what happens when we use periodic inventory, when we use a periodic inventory system, when we record inventory, we use the account called purchases, right? We're actually debiting an account called purchases. And so what happens is that when the company later takes the cash discount, under the gross method, right, we record it at the full amount paid, okay? So then what we do later on is that we credit an account called purchase discounts, which is going to reduce purchases, and then we debit accounts payable, which reduces our accounts payable. Okay, and again, the purchase discounts reduces the amount in the purchases. And we'll see the journal entries in a minute. This is just to get ourselves familiar with the idea of what's going on. Okay, then under the perpetual inventory system, if a company later takes a cash discount, it credits inventory directly and then debits accounts payable. So the debit to accounts payable is the same. It's just the difference is that now with perpetual inventory system, we always use inventory whenever we're dealing with anything related to our inventory. We're not using this purchases account and purchase discounts and other things like that. We're just using inventory for everything. So when we first buy the inventory, we debit inventory. If we take the cash discount later, we credit inventory to reduce it. We're not using all these different purchases accounts. Okay, purchase discounts, purchases. Down here we have purchase discounts loss for periodic. Okay, for perpetual, it's always just the inventory account itself. Okay. And the deduction from inventory just reduces the inventory account and is not directly shown in the income statement. Okay. Next, we have the net method using the periodic inventory system. If a company fails to take a cash discount, it debits an account called purchase discount loss and credit accounts payable. This is going to go under, actually says right here, purchase discount loss is shown under other expenses and losses section of the income statement because it is seen as a failure of management to not take the discount. Okay, so what happens under this, again, we're using net method, right? So we're recording the inventory net of the purchase discount that we expect to take. And so if later on we actually fail to take the discount, what we're going to do is we're crediting accounts payable, we're increasing accounts payable, right? Because we're going to owe more. And then we're going to debit purchase discount lost, which is actually going to basically just be seen as like a loss, right? It's an expense or a loss, okay? It's not going to actually increase our purchases account, but we're going to see it as it's a failure of management. It's basically management's negligence. And so we're going to say, okay, that's called purchase discounts loss. That's actually a loss to us, okay? Then under perpetual inventory system, it's very similar to above. Under perpetual, under gross, if the company fails to take a cash discount, debits inventory and credits accounts payable. The addition, this is now an addition in inventory because it's a debit, just increase the inventory and not shown directly on the income statement. Okay, so that's kind of the just introduction. So now we're going to go through some examples and we're going to kind of see, you know, what we were talking about on the first page. We're going to see it actually laid out in journal entry format and all that type of stuff. Okay, so now for the gross method, first, on January 2nd of 2018, XYZ company purchases $50,000 of widgets from one of its suppliers on account. Okay, the widgets had terms of 210 net 30. XYZ pays half of the invoice price on January 5th, 2018, and then the rest on January 20th of 2018. Okay, so we can see they pay half of this invoice price, so that would be $25,000, right? On January 5th, which would be within the discount period, right? Because the discount period is 10 days, right? So we have, that's within 3 days, and then the rest, the other $25,000 is paid after the discount period, right? Because that's January 20th, well after the discount period has ended, right? Because we only have like 10 days, and that's 18 or so days after the purchase, okay? So it says required, prepare the journal entries for XYZ related to the purchase of inventory, assuming XYZ uses the gross method of recording inventory, and we're assuming that they use a periodic inventory system. Okay, so again, when we see, you know, periodic inventory system, we're thinking we're using purchases, purchase discounts lost, accounts of that nature, okay? Whether you're using purchase discounts or purchase discounts lost, again, it does depend on if we're using the gross method or the net method. Purchase discounts loss is for the net method. Purchase discounts by itself is gross method. So in this case, we're going to use purchase discounts because we're using the gross method. Okay, so again, the gross method, it records the inventory on the books at what you initially pay. We're not going to deduct any discounts we think we're going to take. So we pay $50,000, which means purchases is debited for $50,000. Accounts payable is credited for $50,000. Again, purchases is debited because we're using periodic inventory system. Okay. Then on January 5th, they actually XYZ actually pays for this inventory within the purchase window. Okay. So that means that they're going to get a discount of 2% on the inventory that they pay. So it'd be $25,000. That's what they're paying out times 2% will give you $500. So 25,000 times 2% should give you $500. That's the actual discount that they're going to receive. And so they're going to pay $500 less than what they recorded in accounts payable before. So what we do is that we first reduce the accounts payable, and then we record purchase discounts, which again reduces the purchases account. Okay, so then we would show actually 49,000 of purchases, and then 49,500 of purchases, 49,500 of accounts payable. Okay, then we pay off the remaining accounts payable. We're actually only going to pay out $24,500 in cash because we're receiving a $500 discount on something that initially cost us $25,000, right? So $25,000 minus $500 would give us $24,500 in cash, which means we just debit off the accounts payable for that same amount. Okay. Then on January 20th, they pay the rest of it, and again, it tells you that they pay the rest, and we know that it's $25,000 because as of here, right, accounts payable would be $50,000, then we would subtract $500, we would subtract $24,500. We know we would have $25,000 left, so that means they pay out cash of $25,000, accounts payable is debited for the balance, which is $25,000. It's whatever's left in the account. And then it says, how do the journal entries above change if XYZ uses perpetual inventory system instead? Well, wherever you see purchases or purchase discounts, so here and here, you would actually just have the inventory account. Okay, so this would say inventory here, and this would say inventory here. Okay, so that would basically be the difference if we use perpetual versus periodic. Okay, so that's the gross method. Now we're going to run through an example with the net method, and then that's going to be it for this topic. So again, we have actually the same facts. It's XYZ company, they buy some inventory on January 2nd of 2018 for $50,000. The inventory has terms of 210 net 30. XYZ pays again half of the invoice price, $25,000 on January 5th, and then the rest on January 20th. So those are the same dates as the previous problem. It's just now we're going to use the net method. It says prepare the journal entries for XYZ relates to the purchase of inventory, assuming that XYZ uses the net method, and then additionally assume that they use the periodic inventory system. Okay, so again, we're using the periodic inventory system, we're using the net method. So again, we're using purchases and all those types of things, right? This time we're using purchase discount lost, because again, if we look at our first page, within net method, we use purchase discount lost. Okay. So first, we record the initial purchase net of any discounts, okay? And so in this case, we're going to record the $50,000, and then we're going to take out a 2% discount, right? So that would just be the same as saying, okay, to get to the actual amount that we're going to pay, right, the accounts payable itself, it's just 1 minus 0.02, right? Because that's just the discount. The discount will be $1,000. So that's the same thing as saying purchases for 49, accounts payable for 49, okay? Then we know that they pay off $25,000 of invoice price, okay, initially, but that's the full invoice price. This $25,000 is akin to this $50,000, right? So that's actually not stated net of the discount, right? To get that net of the discount, we have to multiply that by 0.98, and that will give us $24,500, okay? $24,500, and that's the amount of account we're going to take out of accounts payable, and we're going to pay out that amount of cash, okay? We're taking this out of accounts payable because we've already recorded it net of the discount, right? And so when we're actually paying out the accounts payable, we're within the period, and so we're still entitled to that discount. So we need to remove the accounts payable net of the discount as well, okay? Then the next date is where we have a situation where we're outside of the period of the discount terms anymore. We're past 10 days. So now we're not entitled to that discount anymore. So now what we have to do is that we have to record an increase in our accounts payable for the amount of the discount that we lose. And then we have to record purchase discounts loss, which again goes under the other expenses and losses section of the income statement. It's seen as basically the negligence of management that they didn't take advantage of this discount, okay? And that they let it expire, okay? So basically we had $25,000, right, that we have left to pay off, right? It says they paid the rest on January 20th, and we did the math up front. We paid half on January 5th, half on January 20th, so that means it's $25,000 each time. So the discount on that would have been, if we just take the discount to figure out what it is, it would be $500, right? So we actually have to increase accounts payable because initially we didn't actually record that $500, right? We recorded it net of the discount. So now we increase accounts payable for $500, saying we owe $500 more because we were negligent. We didn't meet the discount period. We debit purchase discounts loss, increase accounts payable with the credit. Then accounts payable would have a balance of $25,000, and we just pay that out in cash, okay? Which is a credit to cash, debit to accounts payable, okay? So basically, that's it for this topic, and I hope that was helpful.